As we start to learn about long-lived assets, or what your book is calling plant assets and intangibles and natural resources, we're really talking about equipment and buildings and land and other things that we can use in our business that are going to last us a little while, anywhere from longer than a year, generally speaking, to even up to 30 or 40 years. And so, as we think about assets that we use in our business, we're talking about specifically the ones that help us generate revenue. So, for example, if we are a cookie manufacturer and we need to purchase equipment such as mixers and refrigerators and ovens and seats and tables for people to sit at our cookie retail shop, we're going to buy these assets and they're going to last us a while. And so, as we focus on kind of walking through the key components of depreciation, that's how we recognize the cost of these assets over the time that we plan to use them to generate revenue. And that's the key. So, I'm not going to fill out what is depreciation and what accounts are used. I want you to come back to that after we've walked through the scenarios, excuse me, down below. So, here are some facts. So, if we purchase equipment, remember, this can be anything like freezer, mixers, things like that. I want you to think about the cost. What costs go into that equipment? It's anything that gets it ready to be able to be used in our business. So, this can be the invoice cost, and it can also include freight, if we had to pay any shipping to get it. It can also include any taxes, okay? Anything that we need to get it going. And this follows a concept called historical cost. And that's what we want to stay on the balance sheet for the entirety of the time that we own it. Now, the other component we're going to have to keep in mind is the salvage value. Now, just keep in mind, this doesn't necessarily equal fair market value. And when we book depreciation or record depreciation, depreciation is not really a way for us to assess or determine fair market value. Okay, we never know fair market value until we have a willing buyer and a willing seller. But what we do know is that we need to keep in mind the salvage value of this equipment we purchased, because that's going to help us determine how much cost we need to recognize over this thing called useful life, which just says, how long will we use it? Now, when we practice depreciation in this class, we're going to use straight line. And this is just an even allocation over the useful life. Now, we could also use units of activity, and our calculation would be the same, but we would replace the units of activity with the useful life. So, for example, if we had equipment and we knew that we were going to use it for 100,000 hours, that would be our units of activity. We would do the calculation the same way and apply depreciation based off of the units of activity instead of the time period. So keep that in mind as you're working through the homework. Now, the first question here, what's the annual and monthly depreciation throughout the 5 years? Now, 5 years is the useful life. So what I want you to keep in mind in this particular question is that you may be asked to look at either annual or monthly depreciation. So pay close attention to that, okay? Now, how we calculate depreciation is cost minus the salvage value divided by the useful life. And so when we calculate it based off of an annual determination, we're going to be taking the 50,000 of the original cost minus the 5,000 of the salvage value, and we have an amount that we're going to depreciate of 45,000. So if we take that divided by 5 years, our depreciation ends up being $9,000 per year. Now, we could divide that by 12, and that would give us our monthly depreciation, okay? Or if you knew that you were planning on booking monthly depreciation, you could just go straight to again, the 45,000 divided by 60 months. That's the equivalent of 5 years. And that would be $750 per month. Now, if that's how we calculate depreciation using the straight line method, what does the journal entry look like? Well, regardless of whether it's every year or every month, we're always going to record depreciation expense as our debit because expense is always increased by a credit. I'm sorry, by a debit. So that's 9,000. That's our expense. Okay, we always debit depreciation. You might be wondering, well, what's our credit? We never record depreciation to our asset. We're always going to use a contra asset called accumulated depreciation. And we're going to associate that with whatever account the asset's associated with. So in this case, it would be equipment. And our credit goes to accumulated depreciation. And so take a moment. We're going to stop the video here. We'll come back for the second video, but I want you just thinking about how is it that we calculate straight line depreciation? How might this change if we were using units of activity? And maybe even go back to the beginning here and just make sure that as you think about these questions, what's depreciation and what accounts are used, make sure you feel really comfortable with how and why we're calculating depreciation.